so we are live now. Hello, everyone. My name is Vikas Agrawal, and I'm the founder of AIF and PMS Experts India. So AIF is your alternate investment funds, and PMS is nothing but portfolio management services. So we are here to launch Marcellus Global Compounder Fund today, and we've been doing a series of webinars with Marcellus, where initially we had a launch of CCP, which is consistent compounder, which is more into large and multi-cap space. Then we had Rising Giant launch meet, which is more into mid caps. Then we had Little Champ, which is more into small cap. And we also talked about banking and financial products, which is Kings of Capital. Now, this time, Marcellus has come out with its global offering, which is called Global Compounders. Well, what we're going to do is we're going to hear from Arindam more about this product. How are they going to run? Whether they apply the same philosophy and methodology of selecting stocks, or it is something different. So we're going to talk about that. The total duration of the call is 60 minutes, out of which we'll have 45 minutes of presentation, and then we'll keep the forum open for an answer maybe in last 10 to 15 minutes time. So this is under the PMS platform, Global Compounders, and there is a minimum threshold which is defined by Marcellus that how much they will take. So we're going to talk about that in detail in some time. So let me introduce Arindam. Arindam Mandal is the portfolio manager. He joined Marcellus in 2022, almost quite some time now, and he's got more than 10 years of experience working with US-based firm called Principal Global Investors, which manages close to more than $100 billion. So he's got about 10 years of rich experience on the sales side of equities. He's got about overall 15 years of experience. So he's an engineer from NIT Warangal, and he's also received honors of finance in MBA from Duke University. Here it is. So what we're going to do is we'll start the presentation and then we'll have the question and answer. So Arindam, thank you so much for accepting our request and agreed to do this for our investors.
Great. Yeah. Thank you, Vikasji, for letting us present here.
So over to you. So idea is that these investors would wish to know more about firstly, why this product? Why did you launch this? And B, how are you going to manage it? These are the 2-3 things. If you can just take us through, and then over to you if you want to present it.
Right. Can you hear me?
Yeah, I can hear you now.
Okay, right. Great. Very right questions, Vikasji. I mean, thanks for the introduction. So, let us start doing this. I mean, why did we think about this product, right? That's the first thing. Now, as you mentioned, I mean, I was working with Principal. For last decade or so, I started my journey as an US industrial analyst, and eventually I went through the ranks. And even by 2019, I was looking at the emerging market strategies for our firm, and that is when Saurav and I kind of connected for the first time. I mean, that time also they were in Ambit. They're just about to start Marcellus. Always liked liked him and his team. So by end of 2021, when I was doing emerging market, I kind of had a chance to talk to a lot of Indian HNIs at that point of time, and it was kind of quite evident to me that as a group, I mean, Indian HNIs are underinvested in assets outside of India. Now, why is it important? Of course, I mean, we like India. We are very bullish about India. In fact, in my erstwhile firm, we used to do everything that we can, make our allocation higher for India. So it was an emerging market strategy. So there are certain limitations, but we always made sure that the India allocation is the highest possible. Having said that, there are a few things that came to our notice. I mean, it's a known fact that the US market, if we take the 10 year or 30 years of history, I'll just go to the next slide. You go through 10 year, 20 year, 30 years of history, the TSR column that you see here, there is a total shareholder return and in US dollar terms. And this is basically a list of 15 largest equity markets across the world. Now, India does pretty well, as you can see here. In fact, in 20 year, it is number one. But take 10 year, 30 year, US is actually a great market to be in. So in longer term, there is a very good case for diversification of your assets. And what is the other good part of the return that you get from US is um, it is the volatility is much lower compared to any other markets given the higher liquidity. That is number one. And number two is the correlation between US and India. The stock market return is fairly low. It is around say 40% if you look at 30-year time frame. It is around 50 if you look at 20-year, 22-year time frame. So it is around 50%. And if, as you know, generally within any equity markets like the developed market, you see 75 to 80% correlation at minimum. So 50% is a quite low correlation. What it means is that there is a good case for diversification. So you get better returns, risk adjusted return, because the Sharpe ratio is higher. At the same time, there is a possibility of diversifying your portfolio. So those are the the logical construct when when we thought about why not think about such product. Um, so when you started doing when you thought about going ahead with this, there's another aspect that came to our mind, that like more and more Indians, especially the wealthy Indians, they're building quite a bit of potential liability in US dollar. I mean, most of our kids are going outside to study, right? So there is a need for building assets in US dollar asset, US dollar denominated currency. So if you think about it, like if you are going for a foreign trip, if you're going for your child's education, etc., if you have something in dollar available to you at that point of time, you don't have to worry about the typical dollar depreciation, like the INR depreciation that you see over time. And of course, I mean, there is a chance that always a higher country risk when you're in an emerging market, so you don't have to take those, right? So it gives you, number one, diversification benefit, and number two, build asset in USD kind of denominated asset base. So those are the two crux of it. And eventually, when Saurav and I met again in 2021, we kind of thought about building the same thing, what Marcellus does for other products. In fact, Saurabh told me that there have been many investors reaching out to them that why don't you try doing something similar, take the broad construct of building a quality portfolio and run it on global stocks. How they can also do as good as the domestic portfolios do. And so basically when we discussed about the idea, we thought that okay, this is a time to do that. Now thankfully, Jaibir Singh Sethi, who is the other guy who is the head of research for this product, he used to work for uh, Premji Invest. So basically, he was compounding Mr. Rajim Premji's money. He spent almost 10 years there. And before that, he used to work with Saurav, Rakshit, Pramod, with them in Clear Capital, long back in UK, covering UK stocks. So when he pitched the idea to Jaibir was, he readily agreed, and we formed a team. That was early 2022. Now all the stocks that we see here, both Jaibir and I have covered them for more than a decade in some capacity,
So
right?
Javier is part of. I mean, you are a part of the same team. Like he
Yeah,
heads the
yeah,
research
absolutely. He reads the research part. Yes,
and
I'm
you
doing the
look
fund
after the
management.
allocation part.
Yes,
Okay.
absolutely. Yeah. So the stocks that you see, as I said, the stocks we have covered more than 10 years in some capacity. I mean, Jaibir used to do India as well as global tech. That was a big part of, Mr. Premji's portfolio, as you can imagine. So, so that is how the team was formed. Right now, it is a 5-member team, and we are still growing. Mayank came from Krizel. He had almost 5+ years of experience in doing international small cap equities, and Akshay joined us from IIFL. Minali, she was an internal transfer. She was doing domestic equities with Rakshit before she joined our team. So that is the broad construct of the team. Now, talking about
So add
the
one more point. So
yeah.
while Marcellus and team, they were focusing on domestic equities and promoting their other offerings. Side by side, they were also working on this idea for quite some time now. In fact, I remember Saurav mentioning that they're working on some global offerings 2 years back. So this
Yeah.
idea was going on in their mind. They were doing their own research, and now for the first time they're launching the product. Right, Arindam?
Yeah, so I would say that idea was there. As I said, it was a genesis of people asking them to do something similar for global stocks. But I think what they were lacking, of course, the bandwidth was not there, given that the domestic team operates pretty like in a siloed, right? So they didn't have the bandwidth to do these things, and it was like finding, I think, the right team and right people who have experience in doing that, rather than taking the existing teams, increase their workload, because that will be a newer thing for them, for most of them. So that is where I think that was the bottleneck. So there was a thought process that we should do something like that, but I think the team building, that part we did early 2022. It's a very decentralized in that sense, like we every team in CCP,
Right.
LCP, RG or GCP, they're very decentralized, they operate on their own, right?
Right.
um, so yeah, that is the formation of the team. Now the crux of the product is very similar to what you hear in CCP. So what you are doing here is that you are just selecting deeply moated 25 to 30 companies, global franchises, which are dominant in their respective niche. So that is the crux of the product. So in that sense, I would say, the broad construct is very similar to what CCP, etc. does. Now, of course, I mean, the filtering, etc. is to be done differently because we're looking at a different geography altogether, or geographies altogether. But if you think about it, what we try to do here, we try to divide our investments in three broad groups. The first group, we call them pick and shovel, which is around say 40 to 45% of the total portfolio. And the second thing is called utility, is around 30 to 35% of the portfolio, and the rest is in consumption. So what is pick and shovel? So pick and shovel, basically this terminology, that this kind of investment strategy, it originated from 19th century, 1840s. There was a gold rush in California. So what happened is, like prospective miners, they flocked to California to find gold, right? To dig gold. Um, as happens with every this kind of mining discovery, very few could actually find gold. Mostly they didn't. But irrespective of whether they found gold or not, they had to buy the tools to dig mines. So at the end of the day, the companies that are selling picks and shovels to these prospective miners, they ended up making much more money compared to the miners, the average miners themselves. So that is the broad construct. If you think about in an Indian context, um, paint companies, for example, paint industry is a classic example. So if you are building a house, you have to get it painted. It doesn't really matter if it is a residential building or a commercial building. You have to get it painted. That is the key thing. That's the essential step. And just think about it. Like Asian Paints alone makes more profit when compared against the combined total profit pool of listed real estate developers in India, right? So the basic characteristics of these companies are that they typically address a very large industry. So for example, in this case, the real estate industry, which say 40 year back was probably a 5,000 to 6,000 crore industry, versus the paint industry by itself was just 200 300 crore. Now the hot money, people with big capital, they'll always look for this bigger part of the market, that is the real estate market. So you always find very high competition there. As a result, the guys who are doing this pick and shovel, the smaller things, they get a lot of time to build their moat over time. And by the time people actually realize that how strong the paint business is, Asian Paints kind of companies, they've already fortified their moat so strongly that it's just hard to break in. So you'll find quite a few of these companies in the portfolio. So ASML is a classic example of that. So ASML makes extreme ultraviolet machines which are used in lithography. Now, what is lithography? So lithography is an essential step in etching silicon wafers. So think about it as like a very sophisticated 3D printer. So you have this silicon wafer on top of which you have to print the circuit, right? The circuit design. And with passing time, these circuits are getting more and more complex. For example, this phone has the chip which has almost 14 billion transistors in it. So it is a super complicated process. and ASML's machine can do those. ASML has almost 85 to 90% market share in lithography. So just think about it. Any phone that you're using, if you're using, if you're someone is viewing me in the laptop, the chips that goes into it is a very high likelihood that ASML machine has built those. So the good part of this kind of business is that, like, you don't have to worry about who is winning market share, if it is Lenovo, Dell, or Mac who is winning market share, or it is, more iPhones are getting sold compared to an Android phone. You don't have to worry about those. The bait that you're taking here is that if the world is getting more and more smarter, if that is the case, there is a need of digitization. There is a need of, getting things smaller, kind of packing things, more and more things in a kind of smaller space. If that is the case, the companies like ASML, who enjoys a kind of significant monopoly, quasi monopoly in this space, they tend to win over longer term. Just to give you another example, I mean, how important this company is. So you might have heard like US, China, that like they are trying to, of course, trying to tighten the news. US is trying to tighten the news around China. The first thing that US did, just to take, just to get China under control, they said ASML, which is a Dutch company, by the way, they said ASML that you cannot sell your things to China. You cannot sell the EUV machines to China. So that is the importance of ASML in global supply chain. So that was a few months back. Last week, there was a news that they've actually even asked ASML now to sell their older versions of the machines to China. So that is the importance of ASML in global semiconductor supply chain. So like and the way they have protected their moat, I'll talk about the moat part a little bit later. But the point here is that this kind of companies tend to win irrespective of who is winning the market share in the end market standpoint. So that's the first category, pick and shovel. I mean, happy to take any other company example if you want, but let me move into the second one. So that is, we call them utility. Now the name utility kind of, gives the notion that, okay, we are talking about companies which are very boring, regulated, electricity, water, gas, those are the typical utilities, right? But here we are not talking about those kind of companies. We are talking about companies which are emerging as utilities for a certain group of people or a certain businesses. So Intuitive Surgical is a classic example of that. Intuitive makes surgical robots. The surgical robots are used like, if you think about robotic surgery, the soft tissue surgeries, that happens across the globe. 90% of the soft tissue surgeries that are done by a robot, Intuitive's Da Vinci machines makes, they conduct those surgeries. So Intuitive has a 90% market share in all over robotic surgery space in soft tissue. Now, if you think about it, how did they build this kind of monopoly position, right? Quasi monopoly position. So this started long back in 1992. Uh, they thought about doing heart surgery, but eventually that was not successful. By 1997, they got a patent to do urological surgery. So they'd give them like around 20 years of, head time. And in this 20 years, Intuitive did few things which are actually remarkable. Number one, Intuitive installed their robots or the systems in every medical school in the US. What it meant is that every surgery student who wanted to practice robotic surgery, they have to try their hands on a Da Vinci machine. Now, post their graduation, whenever they join another hospital or they start their own, practice, they are so accustomed to using Intuitive's machine that they cannot think about using any other machine, right? So that is the first level of lockup that they did. The second level of lockup they did is they track the hand movement of every surgeon for every procedure they conduct. What it means is that if you're a 30-year-old surgeon, Intuitive has started tracking your hand movement for every procedure, right? By the time you reach, say, 20, like 55, 60 years of old, like age, Intuitive has tracked all that 25, 30 years of hand movement for different procedures. Now, you often hear that, this surgeon was really good, but he has become old. Now his hand kind of shakes, it trembles, so you don't want to go to him. But what Intuitive does is, if that is the kind of problem a surgeon is facing, it guides it to perform the surgery, like keeping the hand steady, etc., right? Because it has all the data stored in its cloud. So that is the second level of lock-in. So it basically elongates the career span of a surgeon. Now, when you have, kind of created this fine mousetrap when the surgeons are hooked into your machines, the hospitals, despite the cost of an intuitive machine, which is around, say, 2 million or 15 crore, you will find that, like the hospitals have to buy them because the surgeons are the profit center for any hospital, right? So again, that mousetrap is super strong. In fact, all the larger hospitals, even in India, you'll find that they are using Da Vinci machines. In fact, if you go to, I saw that one kind of billboard in Mumbai airport talking about they are using Da Vinci machines in so and so hospital. So that is the brand pull. It pulls, the brand it creates the brand for the surgeons, for the hospitals. Now, this kind of right now globally, only 4% of the surgeries are done through robots. So you can just think about the potential opportunity. Uh, to make it even better, what Intuitive did, it did the third thing. That is, it installed its machines in the hospitals as well as the medical schools. Now, for every robotic surgery that is being performed using those robots, you have to use Intuitive's consumables. What that means is that for every surgery, you have to use certain newer things, like certain different things. Some of the things are just use and throw. So that is part of the razor blade model. Just think about it. You bought a razor, and post that you buying the razor, you have to buy the blades many times. Similarly, you bought an Intuitive system. For every surgery, you have to use Intuitive's equipments. Right now, Intuitive derives around 70 to 80% of their revenue from the blade part of their business, which is the recurring part of that business. So again, those are the kind of utility companies that we have in our portfolio. They have been growing at 15% plus CAGR over last decades. So, and again, given the kind of solid positions that they have in their respective market, we don't see any reason why they can't do it for next couple of decades or so, at least. Then the third group is armies, like armies kind of companies, which are consumption. So the consumption part in India, it is fairly well understood. I mean, like the FMCG companies that we have in CCP. So in the Indian companies supply the daily necessities of the Indian population. India is still a poor country, relative basis, $3,000 per capita income. It can go to say 15,000. But the thing is that the consumption that you're talking about in global compounder portfolio GCP are the companies like armies, which kind of suffice the needs of the ultra rich of the world. So as you might know, the world is getting kind of more and more polarized. The rich are getting richer. In fact, we saw a data point from Credit Suisse that the number of millionaires are growing at around 6 to 8% clip. Take any 10-year, 15-year, or 20-year time period. That is the growth rate of millionaires, number of millionaires. And if you compare that with population growth, which is around 1 to 2% globally, so you can think about the power of the rich getting richer and how fast it is growing. Now, what is more interesting is that there are just very few companies which actually can supply the needs of this super rich. And Armis is one of those. So Armis is basically a virtual monopoly in the categories where they make the most money from. So they make those women's handbags, and some of them actually cost around 2 to 3 crores. Uh, in fact, I mean, there are a couple of stores in India. One is in Chanakyapur in Delhi, and another is in Kalaghora in Mumbai. I mean, it is remarkable. Anyone should actually go and visit them. It is incredible how they have built the scarcity value of a brand. So if you go there, you just cannot go in there with money and buy things. You have to actually build. You have to give a loyalty test. So you have to start buying things like scarf, handkerchief, etc., just to make sure that you are loyal to them. And once you prove your loyalty, Hermes will probably reach out to you via email that, you know, we have 3 bags for you. Do you want to see? If you want, you can give you one of those. You reach there, you might not like any of those because of the color. But if you don't buy any of those, your loyalty score will actually go down. And it might end up that, you might end up never getting the bag you want, right? So that is the kind of scarcity that Armis continues to create. In fact, um, the bag that the Barkin bag, which is their flagship bag, It was actually conceptualized in the 1960s when Grace Kelly, she was an American actress. She kind of conceptualized this bag, and that bag is now sold at around $20 million in secondary market. So the point being here is that the army's bags are not just bags. In used market, they compound at around 10 to 12% CAGR, US dollar CAGR. So they are basically an asset class. And as a result, every year, Army's new products get a price escalation of in that range. So Army's has been compounding its earnings for last century at around 15% plus clip. And given the way we see the world moving, I mean there is no real reason that Army's kind of companies cannot do it for next 25 to 50 years. So those are the basic kind of companies that we have in our portfolio. I mean, we just talked about three. We have around 20, 29 companies here. But now, one thing I'd mention is that the moat part is also very, very important. And the moats that the way we look at moats, they are very process driven. The reason it is process driven because the process is always repetitive, right? So when you think about, we spoke about ASML, right? So ASML's product is of course super complicated to make. They have 150,000 parts. So they have like 50,000 of those parts are just exclusive to ASML. So the complication of is so high that it takes actually around 4 aeroplanes to just take the machine to the desired location, whatever. I mean, so the point being here is that the R&D part is of course very, very important for a company like ASML. But what we think is the bigger part of the moat is they lock their suppliers. So for example, ASML's equipment needs a very, very sophisticated optics part. The lenses are like super kind of specialized, and there's only one company in the world that makes them. The company is called Jace. You might have heard about them. I mean, they make even the regular glasses. So Jace make those lenses for ASML, and ASML has bought a equity stake in Jace. What that necessarily means is that ASML has virtually locked Jace from supplying it to anyone else in the world. So even if a Chinese company think about cracking the technology, but it will be so hard for them to get the supplier part sorted that ASML will have another probably a decade leap in the technology side of it. So that is how, I mean, when you're looking at these companies, it is not just R&D cannot be a strength on its own because Silicon Valley in US, I mean the money is cheap. Millions of dollars are kind of put into R&D. But when you build this kind of additional moat, that kind of fortifies your moat for a longer time. Then the second group, we call them as operational excellence. So this is pretty typical. You definitely see them quite a bit in Indian construct. So again, you can talk about armies. So the reason armies can maintain this scarcity because they control every part of their value chain. So right from sourcing the leathers to the craftsman who actually is building that, making that bag for someone, and a bag is just made by one craftsman. So if some craftsman has been given an order, so that person is responsible for making the entire bag from starting to beginning. It takes 6 months. And then to the distribution, right? So distribution is also controlled by armies. What it means is that they maintain that scarcity value across the value chain, and that is important, right? You do not want to make something that is so special to be available to everyone. So that is operational excellence. And the third part is capital allocation. This is, I think, quite new. I mean, in Indian construct. So capital allocation is something that especially the US firms have excelled in over time. In fact, LVMH is another great company in fashion, in luxury brand. So you might be knowing that, they have this lot of brands being put together. They call themselves house of brands. Now, the LVMH founder, Bernard Renault, I mean, he said clearly that he learned about capital allocation after moving to the US. Now, we have quite a few companies which are actually great in that. Berkshire Hathaway, you all know about it. Heiko is a classic example that we like. It is one of the top picks that we have in our portfolio. So Heiko makes generic spare parts for airplanes. Now, This is two very important aspects when you're making spare parts for aeroplanes. Number one, every aeroplane parts are regulated. So it has to be regulated by FAA. So it is not that anyone can sell a fastener or anything actually to an aeroplane. Number two, the maintenance schedule of these parts are mandated by FAA, that after you fly certain hours or after you fly certain miles, you have to get those parts replaced. So you understand that, right? I mean, it doesn't really matter if the airlines is not making money or anything, but as long as you want to fly, you have to pay companies like Heiko. Now, Heiko has a monopoly in the parts that they make, the SKUs that they make. So that itself is a great business. Now, what Heiko did with the profit that generated from the core business is even remarkable. So they found out that similar kind of dynamic exists in the defense side of the businesses. So in the defense, there are four large players, but within those, below that, in the subcomponent supplier level, there is huge fragmentation, and there are similar characteristics of monopoly driven SKUs that Heiko can exploit. That's what Heiko did. I mean, they did 80 plus acquisitions over last 30 years. Now the defense part of their business is around half of total profit. And Heiko kind of compounded at around 18-20% over last 15-20 years or 30 years. So broadly, when you think about the moat part, R&D, operational excellence, and capital allocation, that is how we have constructed our portfolio companies. So that is the company side of it. Then the second, then other, this is I think interesting that when you think about investing in the US, the first thing that comes into your mind that is very tech heavy, we'll have all the fan mags, etc. But I mean, this is not the case with GCP. In fact, the average age of the companies that we have in GCP, that is around 60 years. The youngest company is actually 27 years. So we are kind of trying to identify a little bit boring kind of companies, but have very good predictability, again, run by excellent managers. And as a result, the tech exposure is generally around 15 to 25% through cycle. It is not what we intended to do, but it is something as a function of the way the stock selection happened, because the characteristics we're looking for, that the firm should be cash generative for a long time, should have a long history. Hence, that is how it panned out. But that doesn't mean that we are kind of compromising on the growth aspect of the business. So for example, the average companies that we have in GCP, they have compounded their free cash flow per share at around 20% plus, EPS at 18%. If you compare that against S&P, that's around 6 to 7%. So of course, I mean, the companies are compounding at much higher rate. And the number that you see with S&P, that has been there for like last 65 years. So S&P compounds at around 7.5%, and the 9.5% total return that you see for S&P in longer term, that is basically a function of that 7.5% and 2% from dividend. So this construct, the S&P construct, remains like that has been like that for a long time. We don't think that is going to change, but our companies tend to do way better than the compounding of that of S&P 500. I just really skip over those.
Yeah, Arindam, have you done
Yeah.
any kind of back testing in terms of performance?
Yeah. So I'll go there. So I'll just address one thing, which is I think important, because um, in terms of the research part, right? That is something you asked in the beginning. So our total universe is around 1100 to 1200 stocks. So we are looking at North America, large and mid cap, plus developed Europe. And the filters that we are doing, they are basically built on the consistency of growth. When I say consistency, that should be through one or two business cycle, and the consistency of returns, again, through one or two business cycle. The return part is a little bit different from what we do in the domestic portfolios, because in GCP, we are more concerned about the cash return potential of the company. So what you're looking at here is the CFO to invested capital, EBITDA to invested capital, free cash flow to invested capital, things like that, and their consistency. So once we do that, um, once we do that, we get around 100 to 120 stocks.
Yeah, sorry to interrupt. So this
Yeah.
1100 companies that you are referring to,
Hmm.
I mean, how many countries you are looking at?
So it is developed Europe plus North America. So North America means Canada plus US, and developed Europe you can think about like Germany, France, Sweden, the Nordic, Central Nordic, and yeah, UK. Yeah,
Okay, understood.
yeah. And we also ran this thing on Japan, but we didn't find anything. So nothing actually crossed, the kind of cleared our filters. Sorry. So that is the first part, and then on top of that, what Jaibir created a very nice forensic framework, and it is actually more bottom up because we are kind of talking about stocks across different geographies. So the accounting rules are different across different geographies as well as some of the industries behave differently. So it's a very bottom up driven forensic accounting approach that you created. Once you apply on top of that 100, we get around 80 to 85 stocks that clear our filters. Then comes the second part, which I think is very important to understand, which is doing the bottom up research on these stocks, right? In fact, that was our biggest concern when we thought about starting this product, because what one thing we never wanted to compromise on is the quality of research, the primary research we are doing. So what we did in turn is that we developed a very solid source of expert networks. How we did that? I mean, there are several expert network providers across the globe. In fact, it has kind of grown significantly over last 5 6 years. So what these expert networks do is to connect you to executives of different companies. So for example, when you are doing work on ASML, so we wanted to talk to some ex-employees of ASML, some ex-employees of their suppliers, or some ex-employees of say TSMC, which is a big buyer from ASML, right? So the expert networks actually connect us to these people. Of course, we pay them quite heftily, but there is a possibility to connect them instead of visiting them in person. So what it the way it helps us is that when you are making our travel schedules, it makes them much more effective, because already you have talked to so many people about a company. Then you know that what exactly you're looking for when you're visiting those company sites, right? And thank like one thing that is notable is that 70% of our businesses are B2B that we have in our portfolio. So having access to this large pool of executives is actually super helpful, as you can imagine. And we showed you the history of these companies on an average is 60 years. So there is really, really a large pool of people who are available. Now, what COVID did is that it took away the apprehension that people used to have, communicating through Zoom, etc. So that actually eventually helped us quite a bit, like they're more willing to talk to us, and over phone or over Zoom. Having said that, once we do those basic primary checks, we do visit the companies, their sites, especially if it's a B2C company. We do kind of visit their stores across the globe. Many of the times our clients, existing clients, they might be working in some of those companies that we're looking into, so they help us connect to people. Or if you're visiting US or say France, we kind of help navigating those countries in a nice way to research those companies. Then the third part is portfolio construction. So the portfolio construction piece is something that we built in-house. Yeah, so after that, I'll take your question on the backtesting part, and we also have a live portfolio actually. So this is a framework that we built internally. So the basic construct behind that was Vikasji, you know, the fundamental value of a company tends to compound at a steady pace, right? That 15-20%, whatever number you put in, there's the orange line that you can see here. But the market's perception of the company's valuation, that changes dramatically, right? The fundamentals don't change that much, but people just overshoot or undershoot companies, like based on their whims. So what we try to address is that if that is happening to one or two companies, it is okay. But if that kind of dislocation is happening for a group of stocks or certain style of stocks, then we try to figure out if there is a way that we can just readjust the position sizing within our portfolio companies. You're not buying or selling based on these signals, but if there is a way to readjust our weights for our companies that you have in our portfolio.
You mean to say that the weightages of the portfolio may change
Yeah,
depending upon the situation of the market?
right. Yes. So for example, we kind of divide our companies, the 29 companies that you have, for example, now, we divide in three subgroups. The companies like armies that you spoke about. So armies is like very continuous, consistent growth. Their customers are not privy to any market like it doesn't matter, the rich people are going to buy those bags, right? If we are in a recession or not, that is the case. So that is the kind of companies we call them defensive growth. On the other side of that spectrum, we have companies like ASML, which are selling to semiconductor industry, which by in nature is super cyclical, notoriously cyclical. So those are cyclical growth. And in between are the companies like the pure growth or secular growth like Intuitive Surgical. So we kind of segregated our companies in these three buckets. Now what you do is we run a quantitative model that is based on several style based factors like value, growth, momentum, etc., along with some macro based indicators which we get from US and other developed markets, which kind of helps us to identify that if there is a severe dislocation in the market in any particular style. Now, if you look back in 60 years of S&P's history that is available publicly, there has been only, I'd say, only 12 or 13 instances where this kind of severe dislocations happened. In recent times, you can think about this 2002, that time frame when the growth stocks kind of went bonkers, fundamentally disconnected with what their value should be. Similarly, in 2021, we again saw another phase, right, that the growth stock went bonkers. In 2015-16, if you can recollect, there was a time that people are talking about that the oil is going to be under $40 per barrel for rest of the life. That didn't happen, so that made the cyclical companies very cheap. The ASMLs kind of companies actually went become very cheap at that point of time. So what the model does is find out these extreme dislocations, and every 4 or 5 years, it tries to identify those times and help us to reshape, reposition our portfolio. So for example, if you see by end of 2021, the 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 talk tool actually was suggesting us to be positioned more defensively. So what that was meaning is that buy more Costco's or buy more armies or buy more Berkshires of the world. Don't get into many growth stocks or don't get into super cyclicals at that point of time. So that tool again is system driven. On top of that, what we have done is we have defined valuation band for every companies. So if a company has overshoot that upper valuation band, we tend to penalize them. Similarly, if it has undershoots the lower band, we tend to add positions respectively. But the talk tool especially is much more helpful to navigate these extremes in the cycles. Now to your point, the original question that you're making. So this is a back test performance, I would say. So what we did is like we took the 29 companies and just see how it has compounded over last 7 years. Again, it is very hard to do an objective fundamental backtest for a fundamental driven portfolio, right? But still, this company is compounded. If I just did equal weighted, they compounded at this 22%. But the performance get boosted by around 3.7% when you apply the portfolio management tool on top of that, right? So that is the value add of the portfolio, like the talk tool basically on the portfolio.
Latest performance of the backtesting. So this is as on 2022, right?
It is the September 2022. The reason it will have till September 2022 because after that we went live with our own money. So this is the backtest, and this is since you went live in October. This is what it looks like. The blue bar is basically the portfolio performance, and the red bar is the S&P 500 net total return index performance. And it is still end of February, actually. Yeah, end of Feb. Yeah, so broadly, I mean, I think I gave an idea about the portfolio, how you look at stocks, what kind of stocks you have, and the portfolio construction. And yeah, we went live. That is pretty much it on the research and the portfolio construction side of it. Um, Broadly, we are looking for the portfolio should do around what we believe is doable is 6 to 9% of somewhere between that of alpha over S&P 500. That is the goal that we have. Yeah, that is the broad construct, Vikasji. I can run you through the structure.
Yeah, if you can just take us through structure quickly,
Yeah,
then we'll have quick Q&A. Yeah.
yeah, sure. So right now in its PMS construct, it will be hosted in the Gift City branch that we have in Ahmedabad. So the Gift City, it is not regulated by the SEBI; it is regulated by IFSC. The minimum investment amount is 150,000, and it is not regulated by us. It is a Gift City regulation. That is the minimum amount of investment that you have to do if you want to invest in any PMS. Um, and this will come through the LRS route for the resident Indians, and the LRS limit is around 250,000 per year, as you might know. Now, um, as of now, the tax collected at source or TCS is around 5%. It will change to 20% from July 1st. And that was one of the reasons that we wanted to fast track the launch. I mean, we initially thought of building a 9-month kind of track record and launching the product in June, July, that time frame. But with the announcement that FM made in February, we thought of if someone wants to actually take out their money, that if someone has any LRS quota left for the rest of the year, that is March 31st, then it might be a good opportunity for them to invest those. Then again, I said that the minimum amount is 150,000. Yes, so there are a couple of things to remember here that this any foreign listed investments, even if you are doing it from your own account, any broker through any broker, so they are considered at unlisted equities, even though if they are listed in foreign. So for those kind of stocks, you have the long term actually kicks in after 24 months, not after 12 months. And the tax on the long term capital gain is 20%. There will be some indexation benefits on that. The indexation benefits comes around say 5%. Basically, it is linked to CPI. But any capital gain tax that comes within 24 months, that will be taxed at your marginal tax rate. And on the other side, the last point is also very important. What you are saying is that if you're thinking about opening an account, go for a joint holding structure, because the estate tax implications in US is actually quite penal. I mean, it is for international investors, I think it is around 35 to 40%. So if something wrong happens with the investor, there is a significant wealth tax that the investor might be privy to. So that is the broad construct of it, and we definitely understand, this is the structure is a little bit penal in that sense. So yeah, but this is what we have for now. We are looking for, we are still not open for NRIs, so we are still working on that. That part of the puzzle should be there in next couple of months or so. And we are also talking about or thinking about a structure, a fund-based structure, which might be helpful for to take care of the inheritance tax part as well as the capital gain tax part, that you can get it resolved in the fund structure versus the current PMS structure.
Okay. So the first question is, how many stocks do you have in the
Right now 29. We want to keep it below 20, below 30. So 20 to 30 is the target that we have.
Okay. How many countries? That I think we've already answered. So
Yeah.
move to the developed countries. We're not going to look at emerging countries at all,
No,
right?
no. I think we already have the best emerging market in the world in US. So there's
Right.
no reason for that.
Okay. And how frequently you want to reshuffle the portfolio?
So there are two parts to it. The stock-based churn, that will be very low. We plan to add or remove maximum 2 companies in a year unless something unusual happens. So that is around 7 to 8% of stock churn. But given the portfolio tool that I showed you, That introduces around, on an average, in a 4 to 5 year basis, on an average introduces around 18 to 20% churn. So the overall annual churn of the portfolio would be around 25 to 30%.
Okay. And so taxation we've already covered. Uh, so these are direct stocks that you'll be buying on behalf of the investor in their demat accounts, right?
Absolutely. So we'll be pulling the money in the in gift. We have tie up with banks, and then you'll be opening a demat account. We'll have the power of attorney. We have tied up with interactive brokers. So you have an interactive broker account for you, which will you can see your stocks. Basically, you'll be buying the stocks in your account.
Yeah. So the framework that you talked about, does this framework also gives you sort of indication that these companies, like you talked about Harmis, etc., they are overvalued and you should be reducing the allocation out there?
Yeah. So that is where the talk tool comes in. So we definitely, as I said, I mean there are two steps to it. Let me show. So there are two steps to it. One is the systematic way of doing it that you do for the entire portfolio in that sense, and then there is, of course, you have the bands defined for each of these stocks. So if they're kind of, in our view, what the band should be. So you look at both the historical as well as the DCF based band approach. So I mean, both have their positives and negatives, and when you're combining both, we think that gives a reasonable uh, band assumption for each of the companies, or the tolerance band assumption for each of the companies.
Okay. And so so question is, what sort of returns one should expect when they are deploying money here?
Yes. So as I said, with the we are expecting around 6.6, at least 6 points of alpha. That is pre-tax and pre-fees, 6 to 7, like 6 to 9. That is what we're talking about. We did some math around the potential capital gain tax, what can be more penal, etc. If I take out the fees, so I would say 3 to 4 points of alpha over S&P's return. That is what we're looking for. In that case, it will be say 9 plus 3, 3.5, which is around 13% of USD return. Now we cannot really comment on the currency part of it. Historically, if I take a 30-year history, the currency has depreciated around 3.5%.
4%.
Now, yeah, 3.5. Yeah, but again, you cannot say that that is going to happen in next year or so, right? I mean, these are very volatile kind of things. There can be extended period of time when the currency might move other ways, but overall, broadly, we think the difference in inflation would remain kind of in that 3% range in longer term. So if that is the case, based on what are the macroeconomic studies that you do, so the 3% depreciation should be a reasonable baseline case.
Yeah. Have you done some kind of study on similar sort of products? How has been their performance? I mean, just as a study.
Yeah. So of course we have few good like we know quite a few good portfolio managers, like Fundsmith is, for example, one of those. And we used to actually recommend Fundsmith and Lindsell Train for many of our clients if someone wanted to invest in those. Again, I mean, very well respected guys. Then nothing, nothing against them. The returns have been pretty good. I mean, quality wise return. One thing we believe we have done extra is this stock tool, which they do not have. And the second thing is that they have become so big now that they cannot invest in companies like, say, for example, Heiko, etc., which are not small company, 17-18 billion market cap company, but given their fund sizes are very high, like say 25-30 billion dollar, it is very hard for them to take position in some of the mid-size based bets that you have taken in our portfolio companies.
Yeah. Particularly Fundsmith has grown big time, like particularly in last 3 4 years.
Yeah. I mean, again, we definitely have a lot of respect for Terry Smith. Nothing against him.
Yeah.
And in fact, I think we have known him way before he started Fundsmith. I think Saurav or Rakshit used to cover his erstwhile company before he actually started Fundsmith. So yeah.
All right. So essentially, the thought process is to identify these businesses with very strong moats. So the thought processes remain unchanged, which is like you're following the same philosophy of Marcellus, but trying to identify companies globally which can offer the similar sort of proposition, right?
Right, and on top of that, yes, and top of that, we are doing this stock tool, which we unfortunately couldn't apply to some of the domestic portfolios just because the absence of high quality cyclicals that you see in Indian market. That is the challenge. In globally, that is not a challenge. So you find ASML kind of companies, and because of that, you can apply this kind of quantitative, a little bit of more quantitative fund management tools. They come to us much handier.
Right. Last question. So, are you also planning to come out with the fund structure? Because knowing the fact that the taxes are going to revise and some of the investors may have some concern over that.
Yes, we are. We are working on that, and we'll ask our sales team to keep you updated on that. I mean, we definitely understand, the concern around the tax. In fact, when I go through that slide every time, it kind of, it kind of gives me that sense that this is actually quite penal in that sense. But at the same time, if there is an urgency to invest before 31st March, do it. Otherwise, you should wait for the fund structure.
Sure. Okay, it was great interacting with you, Arindam. Great insights, so much to learn about global markets. When we are sitting in India, we only think domestic, but one country full investment doesn't make sense. You have to have diversification. And when you are able to get these good moated businesses in one stop shop, why not? You should be giving mandate to Marcellus. So great interacting with you, Arindam. Anything that you want to add before we conclude?
No, I mean, thanks for your time, and it's good to see you. Hope to do many of those in future. But at the same, I mean, I just wanted to say that the diversification part, that angle is really important here. In fact, even in the US, we used to tell our clients to diversify in international equities, even though it is arguably the best, stock market. So the case for diversification is actually quite strong in India too.
True.
I mean, we cannot put any number on that, but generally we'd say 20 to 30% of your equity portfolio. That is a good number to put in global stocks.
Right. I'm in sync with your thought process. So thank you so much once again, and look forward to meet you in Bombay.
Sure. Thank you, Vikasji.
Okay.
Right.
Thanks everyone. If you have any
Thanks a lot.
questions, please feel free to write to me at experts@aifpms.com, or you can visit our website aifpms.com to know more about this product. And if you want to meet Arindam, we'll kind of schedule your meeting with him. Thank you.
Sure. See you. Thank you.